think the Fed's forecast from March saying that inflation would be coming down to the twos by the end of the year was frankly delusional.
Today's inflation report confirmed what Americans already know. Putin's price hike is hitting America hard.
I think you've got to be very modest about what we know about this inflation process. And I fear that it's still going to get worse. We may well get to 9% at this rate.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Risk assets slump around the world as investors price in 175 basis points of Fed hikes by September. Two-year treasuries soar to a 15-year high. The yen extends losses against the dollar to reach a 24-year low. China also reverts to coronavirus curbs just weeks after it started to reopen major cities. Offshore Chinese stocks lead losses in Asia. Plus, cryptocurrencies crash land while Bitcoin slides for a seventh straight day to below $25,000. The picture is even worse for altcoins. Now let's check on the markets because it's a big market day with markets, frankly, all over the place. Certainly all the risk assets trying to find a floor or trying to find a comfortable position for a lot of the investors, depending on what Jay Powell does next. So you see European stocks down some 1.5%. There's a global sell-off that's deepening. I'm looking at stocks repricing, bonds, but also yen significantly slumping. So yen, you can see at 134.65. A lot of the move comes, of course, in the German two-year and the Italian two-year because the ECB is being tested by a lot of market participants, but it's also moving to the longer dated ones. You can see 153 for the German and the Italian at 3.84. Now, what is also extremely interesting is that you see Bitcoin under pressure now maybe being used as a risk asset because we're seeing that fluctuation that is also getting pretty aggressive. NASDAQ futures pointing lower, the S&P pointing lower. And of course, one of the things that we're looking at from a lot of the bank commentary is that the extended sell-off could push the S&P 500 back into a bear market. If you look at tech, over in Hong Kong, one of the biggest decliners, 5% lower as we're seeing more curbs in China. So everything is coming at a flux. It really started with that U.S. inflation print over on Friday. Jay Powell talking on Wednesday. Then we have the Bank of England on Thursday. It'll be interesting to see how Jay Powell, of course, does this. Overall, Bitcoin, again, 24,627. Now, U.S. inflation accelerated to a fresh 40-year high in May. It's an indication that price pressures are becoming entrenched in the economy and shattering consumer confidence. Our guests weighed in on data and its implications for Fed policy.
We see inflation continue to ripple through the economy and wreak havoc.
Certainly the drivers of inflation have broadened out.
Broadening and deepening out.
Everybody knows that inflation is going to be sticky.
Inflation is going to be stickier at a much higher level.
More clarity from the Fed is what's needed for the equity market to find its footing.
The Fed has more work to do.
More to do in the coming weeks and in the coming months.
Rates need to go significantly higher.
Beyond 3.5%.
Between 50 and 75 basis points.
Can the Fed pause in September? Well, we know that the answer to that now is no.
I don't think anybody thinks that we're going to get out of this without interest rates being significantly higher than they are right now.
Now, markets pricing in about 175 basis point hikes from the Fed by its September meeting. That includes at least one 75 basis point move. But even that might not be enough. That's according to our guest, Octavio Morenzi, this morning.
I fear we're drifting into a similar scenario here where the Fed at some stage is going to have to really increase interest rates at a remarkable level, not just 75 basis points per meeting, but like 100 basis points or more very, very regularly every single month to get inflation under control.
Now we're joined by Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, first of all, thank you for joining us, but it's a huge markets day. Or is there danger that actually we're pricing in things wrong, that central banks won't be too aggressive because they still worry about growth, or will they just focus on inflation?
Good morning, Francine. Certainly, I think a lot of forces in play, but I would like to call out some of the structural forces which we shouldn't forget, which is that there is a lot of debt in the system. And there's a limit to how much the key central banks can push policy without triggering a debt crisis. So we are already seeing some hints of that in the Eurozone with the periphery. This inflation, of course, is a huge problem. The Fed and the key central banks have underestimated these forces, but at the same time, those structural forces can start to kick in as well. So this idea that the Fed can go very fast and very strongly has its natural constraints when it comes to the very high debt ratios, and it can make things much, much worse than inflation can.
So what does it mean, Salman, where you want to be invested right now?
Right now, Francine, we remain cautious. We were looking at the relief rally, which happened with very skeptical eyes. We think that further tightening in financial conditions is needed, and that can be achieved by further communication to that effect rather than actual policy maneuvers. So credit market has been very, very resilient, isn't pricing in any kind of proper slowdown in economic growth. So that's where we are focused on. We are underweight credit, and we are cautious on equities. But at the same time, we are also looking at areas of the market which have been affected a lot in this sell-off. For example, in regions, we're looking at Japan.
But in Japan, so what would you be buying? I mean, can you go through the currency, or are you just sticking with certain stock picks?
It's more on the equity side. The currency depreciation is helping from a exporter-based basis, and it's also a leverage play somewhat on China reopening. Of course, news flow on that front has been very volatile as well. As you mentioned earlier, more reports of curbs, but there is a lot of pent-up demand, and credit easing is clearly now kicking in China, which will probably help with strong growth in the second half.
Salman, what's the biggest danger right now from central banks? I don't know whether now's the time to already start worrying that they hike too much and then have to cut in 2023 or 2024, or whether that's a problem further down the line once they get inflation under control.
I think to your former point, we generally think that if the Fed is able to execute what the market is pricing in, then the certainty of a recession is almost 100%. And that means that they will have to reverse course going forward. So it will be a very volatile cycle from a macro and policy perspective compared to what we have been used to in the last 20 years. So that's a new steady state regime, which is much more volatile from a macro perspective. So that's where the risk is, that they basically go too fast. We know the consumer is under a lot of pressure. We are seeing it in the UK that there is now 2 months of contraction. So UK seems to be a bit more advanced in this cycle. We also know from the Michigan surveys that consumer in the US is under a lot of pressure. So growth can fall off quite quickly in the next few months.
Salman, is there something right now that you think is being mispriced or misread by the markets? Do you think that 75 basis points from the Fed is really on the table?
I think there can be a potential talk for it, but we are not in the view that the Fed will notch it up to 75. There is a lot they can do with QT as well, with the pace and the calibration, and of course the general narrative of that. The Fed itself has gotten itself cornered because of the bad forecasting experience it had last year. But at the same time, as I earlier mentioned, there is a lot of debt in the system. We know this. The European Central Bank knows it. And if, for example, Periphery blows up or some part of the big credit market blows up, then you have another issue to deal with rather than just inflation. So it's a very tight balancing rope because we have had so much monetary policy easing in the last many, many years.
So, and you're talking about this tight, balancing act. What's the danger of a policy mistake, and what does that look like?
So the policy mistake for us would look like is basically some kind of a significant liquidity accident in credit markets, and or in the Eurozone, a massive fragmentation in spread. So the financial doom loops, which we have forgotten about so far, start to play back, and that would be a massive policy mistake. And then the second point in terms of more macro cycle would be that the curve starts to steepen rapidly, and inflation expectations start to de-anchor. So far, the inflation expectations are quite anchored below 3%. So the Fed so far has been doing quite a good job in terms of making the market, at least the price market, aware that inflation is not on a runaway path. But that's something we are watching very, very carefully.
Salman, talk to me a little bit about periphery yields, and this is really where it's playing out. If you look at the difference between Italian and German yields, they just continue to widen. That spread widens. Are we in a danger zone where the ECB needs to show what they can do, otherwise markets will continue to test?
I think last week, Ms. Lagarde hinted at potential usage of existing and new tools if the fragmentation increases, but she was quite vague about it. We saw in March 2020, when the lockdowns happened, this doom loop started to take hold, and then the ECB threw the kitchen sink at it. So to our mind, there is a big risk that the market tests the ECB, and you may have a split between monetary policy tools whereby the rates policy is used to tackle inflation, and you may have QE, even though it may not be called QE, but some kind of QE to make sure that the fragmentation remains contained. Because if these spreads blow up and debt sustainability questions come on the table, then we have bigger problems than inflation, which we'll have to tackle with. And one last point I would mention is that in a controlled environment, good inflation is good for the debt ratios.
Salman, thank you so much. We'll have plenty more from Salman Ahmed there from Fidelity International, who stays with us. Coming up, the weekend saw mass COVID testing and rising infections in China. Lockdown fears linger as Beijing, as it finds the latest COVID outbreak harder to control. So we'll have plenty more from China next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China is starting to reimpose COVID restrictions just weeks after it started lifting them in key cities. That's raising concerns that the country may once again employ strict lockdowns to control its outbreak. Well, we're back with Salman Ahmed from Fidelity International. Salman, first of all, thank you so much for sticking with us. When you look at some of the China cases, when you look at supply chains and all of those concerns coming from China, how do you play thematically China right now?
So China for us has been more of a story of valuation. The cyclical macro has been a lot of stress, as we know, because of the very harsh implementation of zero COVID policy. But we have seen some of the lockdowns started to ease, and then the impact on reopening demand. And lastly, the policy stimulus, which was there was a lot of talk about it over the last several weeks, but now we are seeing that in data. So the valuation for us was pricing in a lot of severe negative growth outcomes. And we thought that as reopening comes through, that would be beneficial for China. But it is a very volatile market and remains the one. So that's how we are thinking about it in terms of positioning. But it does benefit from very low valuations.
Does it change some overall, some of the supply chains and your conviction on emerging markets?
Overall, a number of emerging markets, because of commodity prices, especially energy and food prices, are under a lot of pressure. So the importers of energy, we think, are going to remain under pressure, because our view is that oil remains higher. And then, of course, the issues we are seeing in the food markets as a result of the Russia-Ukraine war. So there is this split between commodity exporters and importers we are trying to focus on. That's why we like LATAM, less so of parts of Asia, which are massive commodity importers.
Is there anything in Latin America that actually you like more than others? And again, I guess it's a difference if you're an oil exporting or importing country.
Oil exporting, importing is obviously a key differential. Of course, we are also focused on some of the industrial exporters or exporter of industrial commodities. There's a structural capex shortage in that area. And of course, with the decarbonization themes, they may benefit from a terms of trade perspective. That's something it's a more longer term play for us, because obviously there is a concern about growth slowdown here. But from a more structural perspective, there's a massive supply shortage, which we are trying to focus on countries like Brazil, Argentina on the agriculture side, which we think have valuation support.
Salman, we keep on talking about this exodus in certain shares. So we're talking about repricing in a lot of yields across the world. Do you worry about liquidity in the markets?
Certainly, Francine. This is something which we have been very difficult to forecast. And when it happens, it appears very obvious that why has it happened. But timing it becomes very, very difficult. But these are the kind of situations where there is stress in the system, which can trigger these structural weaknesses, especially in fixed income markets, because of the very high regulation which came after 2008, 2009. So that's something which we are watching for signs very carefully. So the various spreads like FRA, OIS, or signs of stress in cross-currency basis. That's something which we are watching very, very carefully, because they only make themselves visible once a big accident has happened. And this is the kind of environment which accident can happen.
Salman, what kind? I mean, again, is there a trigger point, or how do you see the accident before it happens to be able to change your portfolios around?
So, the QT start would be an important trigger for us, i.e., how does the market absorb, excuse me, the withdrawal of actual liquidity? In the Eurozone, we know that after the QE shuts down, there's going to be a hole of around 7 billion euros in the corporate credit market. This was a big buyer. ECB was a big buyer of corporate credit, and that's a big hole to fill, especially in an environment where rates are going up and the central banks are becoming generalized very hawkish. So those are the trigger points, and then those are specific credit markets which we are concerned about. So another added reason why we are cautious on credit.
Salman, smart as always. Thank you so much. To the point, and of course, always interesting. Salman Ahmed, their global head of macro and strategic asset allocation at Fidelity International. Now, let's get straight to the Bloomberg First Word News. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. China has issued one of its strongest warnings yet about the risk of war over Taiwan. Speaking at the Shangri-La Dialogue in Singapore, Defense Minister Wei Fenghe repeatedly expressed Beijing's will to fight a formal split by Taipei. Bloomberg has also learned that Chinese military officials are disrupting Washington's stance on the Taiwan Strait, telling their U.S. counterparts in meetings that it is not international waters.
To us, the strategy is an attempt to build an exclusive small group in the name of a free and open Indo-Pacific, to hijack countries in our region and target one specific country. It is a strategy to create conflict and confrontation, to contain and encircle others.
European Commission President Ursula von der Leyen says the body's upcoming opinion on Ukraine's push to join the EU will carefully consider the progress the country has made over the past decade. Von der Leyen's trip to Kyiv on Saturday was her second since Russia's invasion. She expressed her solidarity with Ukrainian President Vladimir Zelensky. And U.S. senators have reached a tentative deal on a new gun safety legislation package. It includes giving grants to states to implement a red flag laws, allowing courts to remove guns from potentially dangerous owners, and more funding for mental health services and school safety. Although negotiators must still agree on details, the agreement is a significant breakthrough after years of little progress. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Angel, thanks so much. Angel Feliciano there with the very latest in First Word. Now, first, we're looking at the markets. We continue looking at the markets as there's a massive exodus amongst stocks. This is not filtering only through from Asia, but really impacting how the U.S. will open. Fed rate hike now, 75 basis points, seemed to be a done deal when you look at traders and how they're pricing it in the markets. Now, coming up, crypto takes a beating as the latest U.S. inflation data sours market sentiment. We discuss that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Bitcoin has plunged to an 18-month low amid a broad sell-off hitting the cryptocurrency. This is in line with the ugly start to the week for risk assets. Now, for more on this is our crypto czar, Joanna Ossinger. Joanna, first of all, what exactly is happening with Bitcoin prices?
Hey, Francine. So it is just a multitude of things happening. First of all, Bitcoin was really in a range around 30,000 for a few months. It was getting pretty comfortable there, but it's dropped out of that range below it now as we have the Fed hiking rates. We have concerns of even faster rate hikes. We have inflation running hot. And then on top of that, when we had the Terra Luna implosion last month, and now we have Celsius, a big crypto lender that's frozen withdrawals, you have even more concern about what's going on in the space. So it really is a number of things fueling a kind of an accelerated drop here.
So what's going on, in broader term, Joanna? How do they find a floor, if at all? Is it tracking anything?
Well, there are some suggestions that it could find a floor around its 200-week moving average, which is about 22,000, possibly even around 19,500, which was the 2017 high. But it is definitely correlated with risk assets like U.S. stocks, for instance. And so it actually might be a leading indicator of U.S. stocks later, we'll see. But it definitely works along with U.S. stocks and those kind of big tech names and the riskier assets.
Joanna, thank you so much. Joanna Ossinger there with the very latest on Bitcoin. Our crypto czar. Now coming up, it's a gloomy start to the week, I'll say. Investors' sentiment really hurts. A lot of asset classes moving to try and understand how they reprice the Fed rate hike now of a 75 basis points really being priced into the markets. That's according to Money Markets. We continue our markets conversation and focus on commodities also with our MLive survey for the week. This is Bloomberg. Risk assets slump around the world as investors price in 175 basis points of Fed hikes by September. Two-year treasuries soar to a 15-year high. The yen extends losses against the dollar to reach a 24-year low. China reverts to coronavirus curbs just weeks after it started to reopen major cities. The Hang Seng and the Nikkei both closed more than 3% down. Plus, cryptocurrencies crash land. Bitcoin slides for a 7th straight day to below $25,000. The picture is even worse for altcoins. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I mean, I say good morning, but actually, if you're working in the markets, it's probably a stressful morning. I'm Francine Lacqua here in London. Now, the war and pandemic-fueled shortage of raw materials is set to drive what's already the biggest surge in commodity prices in decades. That's according to the latest MLive Pulse survey conducted last week.
Commodities are very likely to remain supported because demand is still strong.
Best probably still oil.
Our combined exports of crude oil and petroleum products in recent weeks have been at the 10.5 million barrel a day range. That would make the U.S. the largest liquids provider in the world, bigger than Russia, bigger than Saudi Arabia.
We think that actually at the longer end of the curve in oil, we think is where the opportunity is. The short data contracts up above 120.
You look at oil at 120. Doesn't seem that expensive.
Of course, we have everything which is related to food, so anything which is corn and wheat.
Wheat, wheat is in short supply.
And that's mostly because all the geopolitical tensions that we're seeing with respect to Ukraine.
We're planning for continued inflation for the foreseeable future.
The combination of the war and the supply and demand imbalances that were already in place before the war began, especially in energy, will really push up ag, base metals, precious metals and energy together.
We're looking at the likes of nickel especially and lithium. They're the two commodities that we think will do very well over the course of this year.
We expect industrial metals to eventually have a bounce back towards the latter half of 2022 as well, given the fact that now we're seeing a rebound in China.
At this stage, we've got a good call for gold, but we don't think that it's going to be the best performer over the rest of this year.
The pressure is going to continue. We are not at the peak yet.
Well, joining us now is Eddie van der Walt from our Markets Live team and Diana Amoa, Chief Investment Officer at US-based hedge fund Kirkoswald. So thank you for joining us. So exciting having you in London, Diana. But first of all, Eddie, we had this MLive survey, which is basically what you do with commodities and things like that. I mean, it's not surprising, but people are very worried about the price of raw materials.
You know what? I'm a little bit surprised by just how bullish the market is broadly on commodity prices. I mean, we have seen the supply chain shocks come off a little bit. When we look at those CPI numbers, what we've seen is that it's much more about services than it is about goods at the moment. But still, when we ask our readers what they think, they say they worry about commodities. What they worry about most of all is things like wheat. I think the commodity story is one that you have to break down into its sub-baskets at the moment. I think oil has already gone a long way. And of course, that has implications for, wider markets.
Yeah, it has huge implications, especially for the emerging markets, which is your specialty, Diana.
Indeed. And it's interesting because what we're seeing is for emerging markets, food and fuel are the two things you have to watch. We don't think the soft commodity pressures are right behind us, because if you take a step back, everyone focuses on Russia, Ukraine as the big driver. But when you look at food prices, they are up almost 60% from pre-COVID levels. This year, up another 13%. So this pressure on food prices had started well before the Russia-Ukraine invasion because of weather patterns and a shortage in labor markets. We also have we have headwinds coming through from fertilizer prices as well, which actually infer that the pressure from a food price angle is not going away. And fuel as well is the other big one. As much as we might want to see a ramp up in oil production, the issue is actually with the refinery capacity. That you can ramp up all you want, but if refineries can't actually work with that extended production, then it's not really going to move the dial. And that's the conundrum policymakers face, Francine. When you talk about EM inflation, for instance, we've seen this narrative play out already for 2 years. And even despite aggressive hikes, we're still not at the peak of inflation yet. So this conversation that's happening today is very important.
Yeah, and then we'll see what the Fed does, which is what, everything that's happening in the markets, including emerging markets, but it's really, filtering through Bitcoin. You have this massive exodus in stocks. It's basically markets are now, traders are pricing in 75 basis point hike from the Fed.
Yeah, I think, you know what, I think one of the best things over the last few weeks is that we finally discovered a use for Bitcoin, right? We've discovered that Bitcoin is a fantastic measure of risk appetite over the weekend. And it's showing us, where the markets are going to open, and it shows us that the market is still.
So is yen, though.
Yeah, but that is true. That is true. That is true. It's not alone in that space. It's a substitute for a couple of other, But here's, I think the market is very worried about 75 basis points. The market is worried that the Fed is going to come at them aggressively. The market's a little bit worried that there's going to be a policy mistake here, that they're going to kill off demand just as demand, remains strong. At the moment, they worry that this is not going to be the case. They're going to squeeze things like house prices. So, this is a very big conversation. And of course, it does matter for EM and all markets in general.
So, Diana, again, if the Fed hikes by 75 basis points, I don't know whether that's your base or you have to change, a call on that. What does that mean for certain emerging markets?
Well, let's just take a step back. We absolutely think they should hike by 75 basis points. They need to stop talking inflation and start acting and getting ahead of the curve. We've seen this story in emerging markets. Once you lose credibility as a policymaker, you have to do a lot more work later down the line, and that's what tips you into a recession. So they should have 75 basis points at this meeting. Whether or not they will is a big question mark, but them not moving quickly to act, I think is going to be a policy mistake that impacts risk assets globally. Because if the largest central bank in the world is perceived to be losing their handle on inflation, it has ramifications for EMs and for other developed markets. So everyone has to do a lot more work.
But Eddie, so why were they shy? And we heard it from Jay Powell, actually. He almost took 75 basis points off the table. Why were they so shy in dealing so aggressively? Is it, if they hike 75 basis points, does it mean that actually they can't engineer a soft landing? And also the 210 are inverted now.
Maybe, because I think we are seeing a little bit of pressure coming through on the consumer, right? And I think the Fed doesn't want to go faster than they absolutely have to. And we have seen prior to the most recent reading, we saw inflation coming back a little bit. And they were saying, okay, well, let's wait and see. But I think, I think Diana is right. The time for wait and see is over. It's time for show and tell now. And, I think the Fed needs to convince the markets that they are serious, but similarly so the ECB, and they are the ones that are furthest behind the curve here.
So 75 basis point hikes is what you're calling for, Diana. What does that mean for dollar? And again, what does it mean for the emerging markets that you like?
So emerging markets came into this year already having gone quite far along in terms of their hiking cycles. So they are a lot more resilient than they would have been if they'd have been caught asleep on the wheel of inflation, similar to what we're seeing with some of the developed market policymakers. So in that extent, there is a little bit of a buffer built in. That said, when you have 10, 15 basis points moves a day in US Treasuries, it impacts all risk assets. And so we're seeing this broader repricing of global yields that unfortunately, even despite doing all the heavy lifting of hiking proactively, EMs simply can't decouple from that. And so we're still concerned about risk assets. It's been our stance from the start of the year that we think until we get a handle on where inflation is going to be, how much the Fed needs to do to get inflation expectations anchored again, and what the impact of quantitative tightening is likely to be. It's very hard to be necessarily overly optimistic on the prospect for risk assets here.
Yeah, could I just say also, Eddie, we were just getting the 210 inverted, which I maybe mentioned too quickly without spending too much time. I have a viewer, Anthony, thank you. He always writes in and he says we're worrying too much about the ECB and actually the divergence in some of the spreads there, for example, between Germany and Italy, and not focusing on the US and the 210s. What does it mean?
Yeah, absolutely. You know what? I think the market is pricing an aggressive Fed at the moment, this moment in time. I don't think the market is necessarily pricing any sort of a hard landing just yet. If the yield curve in the US is correct and it's telling us something about a recession that's coming along, then I think that this market and stocks in particular have a very long way to go to really pricing, the downside that is possible. And that will feed through into EM, that will feed through into global markets, everywhere. I don't think there's anybody that can escape a US hard landing, but we're not pricing that yet. At the moment, all we are pricing is that aggressive Fed coming at us.
All right, both of you, thank you so much. Diana Amoa, their Chief Investment Officer at Kirkoswald, Eddie van der Veld from our MLive team. Follow our live coverage of markets at MLive, and actually both are staying with us as we continue looking at the markets that are really, really moving. The US 10-year, of course, inverting just moments ago for the first time since April. Coming up later, as London Fashion Week draws to a close, we'll also be joined by Caroline Rush, the Chief Executive of the British Fashion Council. We talk about green, we talk about Brexit, we talk about inflation. It's also the 10th anniversary of the June showcase, and the challenges facing the industry are not minimal. We'll talk about that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we stay on the markets. The market's moving quite deeply. If you look at the U.S. 2- and 10-year curve actually inverting for the first time since April. Now, that signals, of course, signs of an impending recession. There's also huge repricing with a Fed rate hike of 75 basis points. Now, pretty much a done deal for money markets for traders. Now, joining us back is Eddie van der Veld from our Markets Live team, and Diana Amoa, Chief Investment Officer at U.S.-based hedge fund Kirkoswald. So thank you both for staying with us. First of all, Morgan Stanley very kindly just dropped a note in my inbox that basically says, look, the growth risks are still not priced into the markets. What are the markets pricing in?
Yeah, absolutely. I completely agree with them. I think what the market is pricing in right now is a very aggressive Fed. The market is not really there at that point where they're saying, listen, we're heading for any sort of hard landing. The way I can tell that is when I see data releases coming in, we are looking at a situation where good news is bad news at the moment, right? Where hot readings are seen as fueling a Fed narrative rather than telling us a story about the market sentiment overall and the prospects for growth. Yeah. And I think that shows us that the reaction function in the markets at the moment is entirely geared to what the Fed is going to do, not to what the economy is going to do.
And are you expecting some kind of synchronized slowdown globally?
A slowdown, but not necessarily a recession, particularly from a U.S. perspective. When you look at the starting point of this hiking cycle, we don't tend to see the kind of excesses that you've seen, whether it's balance sheets for corporates or consumer balance sheets. So although sentiment was weak, consumer sentiment was weak in the survey on Friday, what's actually different is when you look at the spending behavior, we're not seeing that filtering through yet. So durable goods spending has come down, but services spending is still going up. When you look at the median consumer checking account, it's higher than it was coming into COVID. And so overall, I think the consumers are in a strong place, and businesses have been proactive in trying to deal with these inflationary pressures. So we might see a slowdown further down the line, but unless the Fed really falls behind the curve and is forced to be much more aggressive than markets are expecting, I think it's more of a slowdown rather than a recession.
Yeah, so, I mean, the Wednesday is a huge day. I mean, it was always a huge day for the FOMC, but actually Jay Powell has to walk that line of, how does he see inflation? So how he describes it and characterizes will be really watched out for, and the Fed funds targets.
Absolutely. And, the Q&A is always really interesting because they're always put slightly on the back foot by what they've said before, and, they've been thinking for 2 days straight. It's hard not to make some sort of a gaffe in those situations. Powell's obviously, he's a master in these situations. He can, tell the market exactly what the market needs to hear, or at least what he wants the markets to hear. But, this is probably one of the most important statements that we're going to get from the Fed in a long, long time, because it is hard. It is hard to pull back as hard as you need to on the economy right now without engineering a hard landing. I hope Diane is right.
Yeah.
I think it's going to be a difficult trick to pull off.
Eddie, I have a question for you, a viewer question. Please write in as much as you want, as much as you can, actually. We love listening and hearing what you have to say. So this person writes in, Eddie, for you, does Eddie believe that the VIX is underpriced, and where do you believe market angst fair value should be?
Oh my goodness, that's a hard one. I mean, the VIX is. The VIX is a creature of its own habits. I think that the VIX is probably a little bit low given the uncertainty broadly that we have in markets. I think we're probably going to see volatility increase. I think we generally see volatility increase as liquidity is drained out of the system. Right? This is just a normal functioning. It's a normal functioning of markets. So I think the VIX. We are in a higher volatility regime now. Cam on the blog regularly writes about this higher regime that we're in. I think it probably remains with us. It probably gets worse before it gets better.
And Diana, I guess, there's QT, this broader hiking cycle, capital preservation is what you point to being critical. And then we haven't really touched on China, which could be one of the catalysts also putting pressure on these markets.
Exactly. So there's QT, there's the anchored sense of where rates need to be globally, aggressive hiking, inflation. There's a lot of headwinds, which mean that until markets can form a consensus, and we can't form a consensus if the Fed doesn't necessarily know where they're going, volatility is the name of the game, as Eddie's saying. I think for the next few months, one needs to be careful of engaging too soon in risk assets. I do hear the argument that there's value in certain parts of the market, but we still don't see enough value in some of the big markets. So we still have a preference for being underweight fixed income, short duration, and we actually were fairly cautious on the outlook for credit markets in the short term. As far as China goes, China reopening is going to have speed bumps, right? Yeah. We're seeing that with the news over the weekend. But ultimately, when China fully does reopen, you'll have more demand coming in for things like fuel. So that's going to be an additional inflationary catalyst. That means you can't really call a top on where rates are heading or how price action evolves.
Diana, thank you so much. Diana Amoa, their Chief Investment Officer at Kirkoswald, and Eddie van der Walt from our MLive team. Now follow our live coverage of markets at MLive Go. Coming up, as London Fashion Week draws to a close, we'll be joined by Kailey Leinz, the Chief Executive of the British Fashion Council. We'll discuss the 10th anniversary of the June showcase, but we'll really focus on the challenges facing the industry, including labor shortage and inflation. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Just a quick look at some of the bond headlines, because it is maybe not a bloodbath, but certainly huge moves. Short German bonds actually extending their slide with the 2-year yield rising 10 basis points. Now, on to London Fashion Week, and it's drawing to a close today as the British Fashion Council also celebrates the 10th anniversary of the June event. Now, while it was traditionally an event exclusively for menswear collections, it has since evolved to support fashion that eliminates gender constructs. Now, we're joined by Kailey Leinz, the Chief Executive of the British Fashion Council. Kailey, as always, thank you so much for coming on. There's so much that actually luxury and fashion can give to this country in terms of GDP, in terms of spending and consumer spending. But what's your main challenge right now?
Well, there are so many challenges, of course, particularly for the high street, but also for the designers and businesses that are part of London Fashion Week, that are showcasing collections that are sold all over the world. And, of course, the big challenge for them when they're looking at that export opportunity is really the tariffs that are now in place post us exiting the EU.
Is there any talk about getting rid of those? So, I talk about the markets day in, day out. You're living this, right, through your designers. It's also inflation, it's labor shortages, it's tariffs.
It is, and then we have the added challenge, of course, for our, we're fantastic post-COVID is that welcoming back the travellers to the UK, but we're seeing that spend that would normally happen within UK retail happening in Italy, happening in France, because, of course, those luxury good customers can't claim back the VAT, and they are price sensitive. So we do need some levers to help support our industry and to really think about sort of bolstering the future of not just big businesses and big retail, but the micro businesses across the UK.
Are there any conversations with the government that actually this is something, I mean, again, a lot of the designers have to contend with higher prices in what they make. I don't know how much of that they can pass on to the consumer and whether Number 10 is looking at all of that.
Well, of course, is that we know that consumers are price sensitive, is that everybody will be looking to see how they can try and manage prices. But of course, inflation will have a knock-on effect eventually. Any support from government, of course, being able to look at tariffs is something we want them to do, but it has to be reciprocal because, of course, is that we want to make sure that we're on a level playing field with our European counterparts.
I mean, shipping costs are also going up. Is it something, like, what are the top three concerns, I guess, apart from tariffs that your members are worried about?
Well, they're very concerned about shipping. Again, as the cost went up as we exited the EU, as the shipping costs have really gone through the roof. And we know, of course, because of the rising prices in fuel, that is just going to continue. So that is a real consideration. Fashion's a component part business. You know, we have bits coming from all over the world that come together to create the clothes that we make. And that is a real concern.
What are you most excited about? So without, you know, I know it's not all doom and gloom.
It's really
I guess
not.
The Jubilee also gave a resurgent, or, you know,
it was
kind of
fantastic.
put British at the forefront.
It did. It put the UK at the forefront. Is that it was fantastic to see, of course, in the UK, the consumers out over the bank holiday. That saw a boost to sales, which was brilliant. I think internationally, of course, for London Fashion Week, all eyes are, of course, on the UK at the moment. So it's great for our brilliant creative businesses. And we really hope that that export opportunity will be lived out over the next few weeks as we see, hopefully, their sales soar.
Caroline, what are some of the companies that, I don't know if there's a type of fashion luxury company that can actually pass on some of the higher prices to their customers?
Well, we've already seen some of the luxury good prices go up over the last year or so. So we know that there is an opportunity to do that. Many of the businesses that are part of London Fashion Week really are small businesses, the ones that are mostly impacted with all of the rising costs. They don't have the buying power to negotiate. And so, unfortunately, that is where they'll have to look at passing on some of those costs to the consumers. We'll be working very closely with them, of course, to look at how they do that.
Caroline, thanks so much. As always, a little bit of much-needed glamour in this gloomy bond and stocks market. Caroline Rush there, the Chief Executive of the British Fashion Council. Now, let's get back to the markets because equity and bond moves are steadily getting uglier out there. European trading day, of course, is wearing on. I'm looking at some of the calls or talks on another S&P 500 bear market abound. Traders now pricing in a 75 basis point Fed rate hike. The Stock 600 also extending some of the declines here in Europe, down more than 2%. Now, when you look at tech, it's definitely leading the losses as declines or as bond yields are rising. Cyclical sectors such as auto and consumer products lagging as the recession risks rises. So I don't know where we end up in a couple of hours from now, but certainly there's a bond bloodbath, as our Valerie is putting it. More Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York. Our Anna Edwards is in London. We continue looking at the markets. Also, the risk of more commodity inflation beckons as there's more demand for coal now because of the war in Ukraine. This is Bloomberg.
This is an inflationary process that has been broadening and deepening out.
The risks of eventual recession are rising.
It's a clear signal from the Fed. We're going up and we're going fast.
I think it's important to realize that we got a lot of emotion here in this market.
The Fed's forecast from March saying that inflation would be coming down to the 2s by the end of the year was frankly delusional.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, June 13th. Our top stories today. Sea of red, global stocks plunge and bond yields surge following Friday's shock U.S. inflation print. Investors now pricing in 175 basis points of Fed hikes by September. Over in Asia, the yen sinks to a 24-year low as the Bank of Japan's governor delivers his clearest warning yet that a rapid slide in the currency is damaging the economy. And crypto crumbles. Bitcoin joins the broader sell-off, sliding below $25,000. The lender Celsius freezes withdrawals, further eroding confidence in the crypto space. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and with Kailey Leinz over in New York. And Kailey, we're still really dealing with the after effects, the aftermath of that inflation print on Friday in the United States. We're back to talking about more interest rate hikes and the impact that that's having on other asset classes, a stronger dollar, for example.
Yeah, you maybe want to buy the dollar today, Anna, but investors don't seem to want to buy literally anything else. It is absolutely brutal out there. And really the best way to illustrate it is with the GMM function on the Bloomberg terminal, which shows just how bad the picture is across asset classes. That was certainly the case in the Asian session, where pretty much equity benchmarks were lower across the board, including in South Korea, where the Kospi was down about 3.5%. The Nikkei was down about 3% in Japan. Stocks were down in China and Hong Kong as well. And of course, that continues to be a story with COVID-19 as you're seeing restrictions going back into place in areas like Shanghai. Then in foreign exchange, pretty much every Asian currency is weaker against the dollar. Interestingly, the yen is now the one exception, just fractional strength, which I'll come to in just a moment. And of course, you're seeing that selling pressure in the global bond markets. On the GMM function, you have multiple black boxes for bonds in places like Singapore, for example. So multiple standard deviation moves happening. And in Japan, even, you have that 10-year JGB yield back above 25 basis points, which of course is the BOJ's target. To come back to the Japanese yen, though, specifically, it has started to strengthen a little bit as the session has grown older. But at one point, we were north of 135 on dollar yen. That is the weakest level going all the way back to October of 1998. It is that rate differential story, Matt. The BOJ wants to stay easy. The Fed, though, on a tightening path, and the market thinks they're going to be even more aggressive in the wake of Friday's inflation data.
Yeah, absolutely. It is brutal for risk assets today. We see S&P futures down 2.5%. This after the nearly 3% drop that we saw in the cash trade on Friday. That followed a 2% drop on Thursday. So risk assets come tumbling down. Investors are also selling off bonds. So the 10-year yield rising right now 322.70, but we've been as high as 324 and change. So we're approaching really 325 here, approaching 2011 levels on a 10-year yield. NYMEX crude coming down a little bit on news out of China, COVID, and the negative news there, pushing the Texas Intermediate price down to 118.72. And Bitcoin, this is, Kailey, we've been talking for days about whether or not I should just take this out of the board because we're not moving out of the $30,000 range. Well, today's the day. 24,100 right now for Bitcoin, far off of the level where most retail investors would have gone in to buy. It looks like that model may be broken. Now we're looking for the next level. Anna?
Yeah, we'll get some more analysis on the crypto space later on in the hour, won't we, Matt? Let's bring things back to where we are here in Europe. Across European equity markets, another sea of red. So Kailey was standing in front of that GMM screen, illustrating the Asia picture, very negative, selling everything apart from the dollar, it seems. Well, here in Europe, we're selling stocks, and you can see that very clearly reflected here. We're down by more than 2% in some of the major markets here in Europe, the French market, the German market, the Italian market. And remember, during Friday's session, we did price in some of the response to the US inflation print. We were down by more than 5% on the Italian market, down more than 3% on some of the other major markets here in Europe on Friday. So a continuation of some of those vibes coming through from Friday as we continue to price in more and more hikes from the Federal Reserve and also, incidentally, from the ECB as well. Let's have a look at where some of the damage is really being felt today. And we see that the tech sector is really under pressure. So just as we see NASDAQ futures down more than some of the other major markets over in the US, just here in Europe, we see technology under pressure. Atos is one of the reasons for that. This is a technology company based over in France, and some of the changes that they have decided not to do, some of the assets they've decided to keep hold of, going down negatively with investors, and one particular broker saying this is a bad decision. The stock down by just over 11%. Back to the macro picture, and Italy 2-year yields really in focus. It's the short end of the curve, whether you look at the US or whether you look at Europe, where we do seem to be seeing a lot of that adjustment, that bear flattening move that has a lot of people asking about stagflation and what the markets are trying to signal on that front. We're seeing some big movement here. We were down below 1.2% 2% on the Italian 2-year before the ECB meeting. We're now at 1.9%. So increasingly, the market asking about fragmentation across the Eurozone and what the ECB can do, what tools it has at its disposal to try to stop that from happening. We see those yields on the rise. Go Ahead Group, another corporate I wanted to just briefly mention, Kailey, because this taps into some of the other trends we've been seeing around weakness in the pound and how in play UK assets are as a result. This is a bus company, and we see a number of bidders lining up for this one, apparently, and the stock is up this morning by 21%, Kailey.
All right, Anna, so a lot going on already, and it is only Monday morning, so gear up for a busy week ahead. As for what we can expect in the coming days, on Tuesday, we'll be speaking to Hong Kong's outgoing Chief Executive Carrie Lam in a sit-down interview, so don't miss that on Bloomberg Television. Also on Tuesday, UK Prime Minister Boris Johnson may speak alongside Chancellor Rishi Sunak to lay out the government's economic vision. How are they going to deal more with the cost of living crisis? We'll, of course, get that Fed rate decision on Wednesday. What, if anything, do they say about 75 basis points? Then the Bank of England will follow with its rate decision on Thursday. And finally, the Super Return Conference takes place in Berlin, a major event for the big names in private capital. And Bloomberg's Danny Berger will be on the ground speaking with Carlyle, KKR, Apollo, and more, Matt.
All right, we'll be watching that very closely. Now, though, back to the market drops that we're looking at. The global exodus from stocks and bonds intensifying as investors grow increasingly concerned that inflation will force central banks to squash economic growth with higher interest rates. Bloomberg's Danny Berger has more on today's market action. Danny?
Yeah, the market continues to get decimated by these inflation fears. Started Friday, of course, after that 40-year high in the inflationary reading. But what's really changed today is this ramp up in bets that the central bank, that the Fed is going to have to get very aggressive. We've seen both Barclays and Jefferies after that inflation figure saying 75 basis points is what they expect in June. Barclays writing the U.S. central bank now has good reason to surprise markets by hiking more aggressively than expected in June. So now the market is starting to catch up. 175 basis points priced in by September. That would imply 75 basis points at some point. You do see pricing starting to look 50-50 there when it comes to the July meeting. So all of that means a major readjustment and a painful readjustment in markets. 2-year yields, those are up at the highest since 2007. 2s, 10s, that curve has inverted just moments ago. Your 2-year yield in Germany above 1% for the first time since 2011. And the Periphery, Anna, you were explaining this, getting slammed as well. This is the third day in a row of moves in Italian BTPs in the 2-year at least of more than 20 basis points. The spread between these two, the superlatives, I know they're endless here. The spread between these two, the widest since 2020. And of course, the 10-year yield in Japan moving above that 25 basis point upper bound set by the government. So it's a global bond market, and that hitting equities as well at the moment. Futures indicate that the U.S. is set to open up into a bear market, Anna.
OK, so Danny, it's a gloomy picture when it comes to risk assets this morning. And sticking with risk assets, crypto lender Celsius paused withdrawals, swaps and transfers on its platform, fueling a broader sell-off in that space. And Matt's been through the action we've seen on Bitcoin. What's the latest?
Yeah, that Celsius pausing of lending and services really just adding fuel to the fire. It's this idea, Anna, that this froth in the market, it no longer will be supported if the Fed is going to get aggressive, if they're drawing liquidity from the system. So Matt showed Bitcoin down 12% now, Ether 20, the Bloomberg Galaxy Crypto Index, that down 5.6%. We saw it with Terra before, concerns of just corners of the market breaking. Is this bigger than a quarter? Is it something that is going to break the system with the Fed? As Barclays says, they think they're going to move 75 basis points on Wednesday.
All right, we'll see what happens. 2 days to go until that decision. Bloomberg's Danny Berger, thank you so much. Now let's get back to the Japanese yen, which fell to its lowest level since 1998, prompting warnings from the Bank of Japan as its easy monetary policy increasingly feels the strain of rising interest rates elsewhere around the world. Joining us now for more is Enda Curran, our chief Asia economics correspondent. So Enda, Kuroda's starting to get worried about the Japanese yen here. Is it likely that Bank of Japan policy is going to change?
Well, he made clear that the yen's weakness is certainly a negative for the economy. He made it clear that it makes it difficult for businesses to plan. And he said that the Bank of Japan will work with the government to try and offset the impact of the yen slump. Now, as you say, though, it's not necessarily clear what the Bank of Japan can do in response. They do have a policy meeting this week. Some economists are saying they may use that meeting to tweak some of their toolkit in response to the yen's weakness. But I think the overall view among markets is that the yen's weakness is being driven by this big divergence with the Fed, and there's little the BOJ can do about that in the near term.
Yeah, and elsewhere in Asia then, a lot of focus on a sell-off in commodities linked to the latest news lines coming out of China, walking back some of the virus loosening measures that we'd seen them bringing forward previously. So things getting tough on the COVID front once again.
It is getting tough again, Anna, and it does seem to be a backward step. Remember, in both Beijing and Shanghai, we had been hearing about restrictions being eased in recent days as cases there collapsed. Well, we've had a tick up in cases again, in particular a cluster at a bar in Beijing. That's prompted the authorities to keep schools closed there and implement more mass testing. Likewise, in Shanghai, dine-in at restaurants has been banned in some areas. So it all speaks to the idea that China is sticking to its COVID-0 approach. But of course, COVID-0 is now having an outsized impact on the economy, and economists again warn today, given how transmissive the Omicron variant is, the ongoing policy response is posing a real threat to the economy through the second half of the year.
All right, Enda, thanks very much for joining us. Bloomberg's chief Asia economics correspondent, Enda Curran, there talking to us about what's going on in China. In terms of the military, China has issued one of its strongest warnings yet over the risk of a war in Taiwan. Speaking at the Shangri-La dialogue in Singapore yesterday, China's defense minister repeatedly expressed Beijing's will to fight a formal split by Taiwan.
If anyone dares to secede Taiwan from China, we will not hesitate to fight. We will fight at all costs, and we will fight to the very end. This is the only choice for China.
Joe Matthew joins us now, Bloomberg's Washington correspondent, for more on U.S.-Taiwan relations, U.S.-China relations. Joe, I mean, even though we sort of knew this, it was unspoken until now, this red line.
Yeah, they've been talking a little bit more about it lately, though, Matt. It's interesting to watch the rhetoric heat up here. And indeed, some of the most full-throated remarks here that China would fight. And it follows remarks from Defense Secretary, U.S. Defense Secretary Lloyd Austin just a day earlier talking about America's Indo-Pacific strategy, saying, quote, the stakes are especially stark in the Taiwan Strait. By the way, those two met in person just a couple days earlier on Friday, with Minister Wei saying China will not hesitate, as you heard, to fight to keep Taiwan a part of China. But this rhetoric is frankly nothing new in a decades-long standoff here. Lately, though, we've been hearing a lot more about it, Matt, against the backdrop of the war in Ukraine.
Meanwhile, on the domestic front, Joe, of course, we've seen a number of mass shootings recently here in the U.S. And in the wake of those and following the March for Our Lives protests in Washington over the weekend, we now have a deal, a bipartisan deal on gun legislation. What can you tell us?
It's a few weeks in the making here. As we told you, Democratic Senator Chris Murphy of Connecticut was talking with John Cornyn, the Republican from Texas, following the shootings in Uvalde, and they have, in fact, generated a deal here. We do not have a bill. We do not have legislation, but 10 Republicans have signed on to what is essentially a handshake deal here with red flag incentives, more comprehensive background checks for gun buyers under 21, even closing the so-called boyfriend loophole, which includes restraining orders in those who've been convicted of domestic violence. This is something that will likely come to light in the next couple of days in terms of details. Chuck Schumer, the majority leader, says he wants to get a vote on this as soon as possible. The president says he's prepared to sign it.
Joe, thanks very much. Thanks to Bloomberg's Joe Matthew. You can listen to Joe every weekday on his radio program Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Sticking with politics, let's get to France. Polling suggests President Emmanuel Macron may lose his outright majority in Parliament, forcing him to compromise to push forward reforms ahead of the next round of voting. Joining us now is Bloomberg's Caroline Conan in Paris. And Caroline, it was a bad night then, I guess, for Emmanuel Macron. He has only a week now to convince the electorate if he wants to hold on to that majority.
Not the best night for Emmanuel Macron, definitely, Anna. Unlike the presidential elections, the threat this time is not coming from the far right of Marine Le Pen, but the far left of Jean-Luc Mélenchon, Mélenchon's party, the NUPS and his allies actually are neck and neck with Macron's party at around 25% in this first round. They will face each other in local ballots next Sunday, and Macron could actually be short of the 289 seats he needs to secure majority in parliament. Mélenchon from the far left has been campaigning on anti-inflation measures. He wants, for example, to increase the minimum wage, to also cap all essential products prices, and to lower the retirement age to 60 years old, which is the exact opposite view to Emmanuel Macron, who wants to increase the retirement age in order to finance his other reforms. The most likely outcome, however, due to this two-round system in France, is that Macron gets a relative majority next Sunday and is forced to build some fragile alliance with the Republicans and fight on every single bill and reform.
All right, Bloomberg's Caroline Conan in Paris, thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. No surprise given the big declines we are seeing in the crypto space. That is translating into crypto-related equities in pre-market trading. Huge downdrafts for the likes of MicroStrategy, Marathon Digital, Riot Blockchain, Coinbase. They're all down at least 12%, 17% in the case of MicroStrategy. The other stocks that you're really seeing leading the losses today are large cap technology. The likes of Apple, Amazon, Nvidia, Tesla, they all also are lower and, of course, are huge heavyweights, huge drags on the equity market. Nvidia is down 4%. For Apple, Amazon, and Tesla, they're all down in the ballpark of 3 percentage points, Anna.
Kailey, coming up on the program then, Kokou Agbo-Bloua will be joining us, head of UK research at Societe Generale. What does he make of the changing, shifting, hiking expectations with regards to the Fed? Is 75 basis points on the table? Is it on the table this week or later on in the summer? And Bitcoin at its lowest level since December 2020. More on crypto ahead. Plus, the latest warning from China to Wall Street. Don't reward top people too lavishly. Read more by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kailey Leinz in New York, Anna Edwards out in London. Now, we are looking at 175 basis points of hikes being priced into essentially the next 3 meetings for the Fed. Ven Ram joins us at Bloomberg Markets Live now. And Ven, a lot of people are saying this means a 75 basis point hike is a done deal. I could imagine the Fed saying, you know what, this inflation situation is serious enough for us to go 100. Is that a possibility?
It is definitely a possibility. It's definitely something that the Fed should be looking at, but it's not something that I think all the same that they will do, because inflation has been streaming higher for months now. And we've already seen their response. It's that they want to go at 50 basis points. And the only thing that's holding them back, rather than going at the 100 basis point pace that you mentioned, is the fact that they don't want to shock the economy into a recession. That is very much in their calculus. And
it would stop inflation.
Sorry?
It would likely slow inflation down, wouldn't it? A shock maybe is what this market needs.
Absolutely. I mean, I think that the Fed should have gone much earlier, as I've been saying, and they should have come in and out of policy emergency meeting and then raised rates. And that would have delivered the shock and awe that the markets need. But given the way this particular Fed under Powell operates, they are very clear about one thing. They don't want to surprise the markets. And considering that they've teed up 50 basis points, I think they will go with 50 basis points. And it would be interesting to see Powell then say whether 75 basis points is on the table for subsequent meetings.
Okay, and that ties in with the views of a couple of guests I spoke to in earlier TV programming, Ven. Briefly, the European story, we see 2-year yields in Italy really on the rise, and the pace of this is really speedy. I mean, we're at 1.8% on the Italian 2-year. It was 1.2% before the ECB meeting. How long do we keep up this pace of gains in yields?
I think that, both front and back end yields in Italy have got a lot more to rise, simply because bunds are rising. And if bunds go rising, Italian bonds, which have a higher beta, will have to rise even more in a much more accelerated fashion. And that is likely to cause a lot of political noise in Italy because of what's happening and the optics of it. Definitely fragmentation is a risk, but it's not a risk at this point. But if we see yields rising much more in the coming weeks, we can see the ECB coming out in full force and saying that, look, we have a plan B to backstop these peripheral yields.
Okay. Ven, thanks so much. We will listen out for any commentary we get then from the ECB. Ven Ram from on the markets there. And remember, you can get more market analysis. Check out MLIV Go on the Bloomberg terminal. This is Bloomberg.
After Friday's hot inflation data, traders are pricing in 175 basis points of Fed hikes by September. Stocks and bonds getting sold as a result. The 10-year at 323. The S&P set to open in a bear market. We'll discuss it with Kokou Agbo-Bloua, head of UK research at SocGen, next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Sea of red. Global stocks plunge and bond yields surge following Friday's shock U.S. inflation print. Investors now pricing in 175 basis points of Fed hikes by September. Over in Asia, the yen sinks to a 24-year low as the Bank of Japan's governor delivers his clearest warning yet that a rapid slide in the currency is damaging the economy. And crypto crumbles. Bitcoin joins the broader sell-off, sliding below $25,000. The lender Celsius freezes withdrawals, further eroding confidence in the space. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, a lack of risk appetite, it seems. And we're still dealing with all of the fallout from Friday. And we're not going to hear all that much. Well, we're not going to hear anything from the Fed until Wednesday. They can't steer, they can't guide us in our thinking as to what to expect.
They could. I mean, they could always do a surprise announcement. It's happened in the past, but it doesn't look like that's the kind of thing in the cards for this Federal Reserve. Take a look at what we're seeing in S&P futures. I would say we haven't seen these kind of numbers on S&P futures in a long time, except that we saw them on Friday, not pre-market, but S&P futures at one point Friday were down 2.9%. Still, this is a big drop considering the fact that we were off in the cash trade almost 3% on Friday, 2% on Thursday. So risk assets just selling off. I think it's the worst quarter for the 60-40 portfolio since 2008. Dan Curtis, our producer in London, pointed out to me when I said that we're also seeing a sell-off in bonds, right? 323.45 on the U.S. 10-year yield, getting back to a level that we haven't seen since 2018 and almost to those 2011 levels on the 10-year yield. NYMEX crude coming down as the COVID numbers start to, and some measures start to freak people out in China again. Right now, 119.34 is the level for Texas Intermediate. And then Bitcoin, an unbelievable drop. This is 12% from midnight, but of course, we've been holding it very steady at that $30,000 range, and it looked like we were never moving out. I was going to eject Bitcoin from my board, but now we're off more than $5,000, almost $6,000 from that level at $24,120. As you said, the fact that Celsius is freezing withdrawals, really spooking people in this market. Kailey, what do you see in terms of pre-market movers?
Well, Matt, I really feel like you manifested what we're seeing in Bitcoin because you were getting so bored with it in and around 30,000, and now we finally have a breakout of that. And because of the fact that that breakout is lower, you are seeing crypto-related equities moving substantially lower in pre-market trading as well. The likes of MicroStrategy, kind of a big Bitcoin proxy stock, down about 17%. You have Coinbase, the crypto exchange, down nearly 12 percentage points as well. And it's not just the crypto players that are under pressure. You are hard-pressed to find really any stock in positive territory in pre-market trading, but the ones creating the largest drag on this equity market are those large-cap technology names, the likes of Apple and Amazon, each down more than 3%, Anna, and it is hard for a market to hold up when those stocks are not, Anna.
Yeah, absolutely. In the US, European tech plays a different role, but European tech also under pressure here. So the Stoxx 600 in the European session now 2.5 hours into our European trading day, down by just over 2%. And of course, some of these markets in Europe, to Matt's point, lost more than 3% on Friday, lost more than 5% if you're talking about the Italian market. So we have some serious downside moves here on European stocks. The technology sector in focus, as I mentioned, down by 4% in today's session. The Italian 2-year yield helping us to focus on what's going on in sovereign debt here in Europe as as well. So we're seeing the market pricing in further hikes from the Fed and also from the ECB. And as the ECB steps away as the big buyer of sovereign debt in Europe, what does that do to spreads between Italian and German bunds? And so we're certainly focused on that. 1.9%, the yield on the 2-year. This number is moving up fast. Go Ahead Group, I put this one in here. This is a bus company that does bus services across the UK. Apparently the number of bus journeys being taken really on the rise as people try to find alternatives to driving cars as that becomes more expensive. And a reminder that there is still some M&A happening in this market. This business has received multiple bids, it seems, Matt.
All right, so we'll continue to watch what's going on in Europe as well. Well, it's a global sell-off, isn't it? So it's happening around the world. Right now, markets pricing in 175 basis points of hikes from the U.S. Federal Reserve by its September meeting. That includes at least one 75 basis point move if you don't think they'll go over 75. They could do 150 and 25 or 25, 50 and 100, et cetera. And so forth. Let's listen to what Optima's CEO Octavio Morenzi told us this morning.
I fear we're drifting into a similar scenario here where the Fed at some stage is going to have to really increase interest rates at a remarkable level, not just 75 basis points per meeting, but like 100 basis points or more very, very regularly every single month to get inflation under control.
So there is another way if the Fed were willing to make that step. Kokou Agbo-Bloua joins us right now, SocGen's head of UK research. Kokou, doesn't seem like a lot of people put that much faith in the Fed, that they could actually take such a shocking step.
No, actually, because they also have other tools like, the runoff of their balance sheet. This is also a powerful mechanism in terms of sort of mopping up liquidity in the system. But there's also an important element to bear in mind is that if you look at the five-year break-even inflation, it has been quite stable compared to the very aggressive dynamic we're seeing on the realized inflation front. So what this suggests is that the long-term inflation expectations are still anchored, and the Fed ultimately realizes that its monetary policy, it takes 6 to 9 months before having a real impact on the economy. So being steady and not panicking too early, I think is essentially important in terms of credibility for central bank.
So, Kokou, does that mean that 75 is also off the table for this week? And if it is, does it mean that we probably will get 75 later on in the summer?
Well, I think it will be very data dependent. I think clearly the market is pricing at 75, but ultimately it's something that would be unprecedented. One thing to mention on the data last week, you also noticed that core inflation was lower than the previous month, even though it was slightly higher than consensus. It was the the headline inflation that was higher because of food and energy dynamic being very strong, mostly led by essentially gasoline prices moving faster than oil prices because of refining capacity problems. So we are clearly close to the peak of inflation, and there are essentially commodity and energy related volatility. But I think it is important to take a step back and realize that it is not a question of if inflation will peak, but a question of when it will peak, and we are close to that peak.
OK, we're still looking to get to that. If you look at bond markets and the clues they're giving you then, Kokou, I mean, we've seen 2s, 10s inverting once again. And then when you look at expectations for rate hikes and then to rate cuts, it seems that the second half of 2023, the market now expecting the Fed to cut. So do you think that the end of the hiking cycle is just getting closer and closer, that the longer that inflation stays at these elevated levels?
Yeah, absolutely. And this is one of the things that was different in the sell-off we had last week compared to previous sell-off, because the oil and gas mining sort of basic resources were the sectors that were still up year to date and were typically benefiting from higher commodity prices, and also financials. And this time around, you're starting to see those mining commodity-driven sectors down, similar with the bank stocks, which typically sends you a signal that the market is worried about a recession. And this is clearly one of the collateral damage of reining in inflation aggressively, and the market is fearing the last two to drop ultimately.
So, Kokou, for you, how much greater are the odds of a hard landing this morning than they were at 8:29 a.m. Eastern on Friday?
Well, I think they are clearly higher, but I think it is important to also bear in mind the sort of the question of is the glass half full or half empty, there's still a tremendous amount of cumulative excess savings that is buffering this sort of cost of living crisis. But the odds are clearly higher than they were last week.
So if that's the case and a hard landing is potentially a more likely scenario and growth is going to be an issue going forward, how much higher can yields realistically go before the bid for haven comes back in?
Yeah, so that's a very good question, because we have to factor in the risk of sort of a balance sheet runoff, which could create this supply-demand dynamic where yield could go much higher than where the fundamentals would dictate, as asset managers essentially de-risk their portfolio because they're literally losing money from every asset classes today. So I think, a 3.5 level would be shocking, but it is very difficult to take into account the negative convexity dynamic that could push yield much higher. But I'll say 3.5 would be an interesting tipping point.
We just saw today, Kokou, the VIX finally go above 30. I was shocked it didn't on Friday. But we've seen this kind of slow grind down. Admittedly, big moves in markets, but not capitulation, right? What do you need to see before you can say, the market has given up the ghost?
Well, you need to see the sectors that were benefiting from high oil prices start to roll over. And this is one of the factors that kept dispersion or low correlation within the equity indices, because you had commodity, retail or consumption or demand-sensitive sectors already being down 30 to 35%. And at the other end of the spectrum, you had commodity and sectors with strong pricing power that were holding up the market. So now we should see those strong sectors rolling over because there is a pricing of more demand destruction. Then you will see correlation going up and the VIX ultimately breaking to new highs. But I don't think we're there yet. I think the jury is still out in terms of whether we're going to have a strong or, let's say, a hard landing, completely destroying demand more than what the saving or excess savings is doing today, because you still have to realize that sort of corporate balance sheets are still very strong in some aspect of the market. But it is true that the credit market is sending some very worrying sign as well. So we are at an interesting tipping point today.
Kokou, thanks so much for your time. Kokou Agbo-Bloua from Societe Generale. Thank you for joining us. Coming up on the programme, we'll get to the big moves in Bitcoin. It's at its lowest level since December 2020. More from today's crypto report next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, crypto lender Celsius has paused withdrawals, swaps, and transfers on its platform, fueling a broader sell-off already taking place in digital assets. Bitcoin now at its lowest price since December of 2020. We are south of $24,000. Mike McGlone, Bloomberg Intelligence commodity and crypto strategist, joins us now from Miami for more. So, Mike, we've been in this range, $2,000 or $3,000 south of or north of 30,000 for weeks now. We have finally had a material breakout of that to the downside. How much more further can this go until some kind of technical support kicks in?
Well, hello, Kailey, and good morning. I think what you're seeing is the beginning of the great reversion of 2022. And it's cryptos was the highest beta market going up, so it's the highest beta market going down. So I think the next key levels are Bitcoin and Ethereum has been a key indicator, is around 20,000 in Bitcoin, Ethereum around $1,000. But the key thing that shows the significance of Bitcoin told us on Saturday morning when it started breaking down that this was going to happen in all assets. And that's what's really changed, is Bitcoin is going to come out of this ahead. But I think the key thing to think about is when people say inflation's not transitory anymore, you got to look on the streams and say that shows you how transitory inflation is going to be. And the next key issue is going to be deflation. But this time it's going to last a while because all assets are going down. And so to me, big cryptos and Ethereum, it's just they're the good leading indicator now.
By the way, in terms of Ether, there is this story that Lido Finance has accumulated 31% of the stake for, the the new blockchain, the merge, and that the difficulty bomb hasn't been set off. Now, I know that's a lot of jargon, but it's basically to say that we're not going to switch to proof of stake from proof of work maybe as soon as we thought we would, and it's already been delayed for so long. What are your thoughts on POS, Mike?
Bumps in the road, Matt. It's one thing about the technology. I don't understand it so much, but we fully expect bumps in the road, and we're getting them. It's that we should expect. But I think the key thing to think about in cryptos here is we're going to look back in history, and when my grandkids say, hey, Grandpa, what was Shiba Inu? And they'll say to me things like, you mean you can't add value to the stock market by just splitting stocks? This is all assets, and even bonds are going down. It's just cryptos are down the most. But the thing about Ethereum, what it's doing is revolutionary. It's like it's making crypto dollars and stable coins happen, and they're the most widely traded assets. So you got to look at it 5-10 years from now, Mike, is what they're really doing to infrastructure.
We're not seeing, I mean, it isn't all assets because gold hasn't tanked as inflation beats expectations. And frankly, a lot of people are out there saying, I thought this was what Bitcoin was supposed to do. It's supposed to be a hedge against inflation. The scarcity is built in. Why isn't it working?
It will eventually, Matt, but the world's best performing asset needs to come back a little when the Fed sees the Fed's taking away the punch bowl. And that's the key thing to think about here is the markets are doing the tightening for the Fed. So look ahead a year from now, the issue is going to be easing, but they can't ease because we've all learned that lesson. We'll never go back and create the kind of liquidity we did because inflation that came out of it. But it's what happens looking forward. I think the key things to come out of this ahead are Bitcoin, long bonds, and gold. And look, even gold's getting hit today. And those of us who remember trading in 2008, you hit gold right away, but then it came back.
And let me ask you, sticking with the crypto space then, Mike, let me ask you about Celsius. Things got too hot for Celsius, it seems. They had to freeze withdrawals, that fueling the market rout. I mean, what do you read across from that particular instance, just in the same way that we were asking about around Terra USD and Luna? What do you read across from this particular episode?
The tide has gone out. We're seeing who's wearing clothes. Now, Celsius was one of the first to provide interest and provide income to cryptos and stablecoins, and now they haven't said they're going to. They said they're going to come back, but if they fail, that's a big problem. What's really been happening in that space, it just got literally too excessive. It was the excesses of excess, and we're pulling that back. But it depends. If they fail, that's going to be an issue. I think right now they're just holding back until things calm down. But again, the tide went out. We see who's wearing clothes. Terra Luna was just silly, algorithmic stablecoins. But we're seeing the legislation coming from the bipartisan bill where we're going to focus on crypto dollars, and they're going to have to hold the proper collateral. So I think that's going to work out okay. But right now, we're just the markets are doing the tightening for the Fed. So we're not going to have to worry about the Fed, and if this keeps up.
All right, Mike, thanks so much for joining us. Mike McGlone there from Bloomberg Intelligence out of Miami. Tune into Bloomberg Crypto, by the way, every Tuesday at 1 p.m. New York time, 6 p.m. London. This week, we're going to hear from the CEO of Webull, a commission-free trading platform, so long as that's allowed by the SEC. This is Bloomberg.
I think you've got to be very modest about what we know about this inflation process. And I fear that it's still going to get worse. We may well get to 9% at this rate.
Fed's forecasts have tended to be much too optimistic there, and I hope they'll recognize fully the gravity of the problem. When inflation is as high as it is right now, and unemployment is as low as it is right now, it's almost always been followed within 2 years by inflation, by recession.
Mohamed El-Arian on CBS, Larry Summers on CNN over the weekend. Tom Keene joins us now, anchor of Bloomberg Surveillance, to talk about what he makes of inflation's impact on the markets. And Tom, what is your single best chart of the day?
Well, the single best chart is about the markets. The market move is a story this morning. There is no other story. It is in bonds and it is in equities as well and expressed through commodities, but far more foreign exchange with new dollar strength. We go to the equity market, and for global Wall Street, it is about the VIX. And just looking back to 2006, you've got some stasis there between once-in-a-lifetime events, the financial crisis, the pandemic. And up we go again, breaching above 30 right now, Matt, 32.84, up 5 big figures. The Dow, negative 627.
Yeah, Tom, some of these market measures of stress on the move, and some of them on the move pretty quickly. What is the lineup of guests that you have to take us through all these market moves?
Well, we're doing two things. We're blowing up the show. We've got some wonderful people we had on other topics. We've said goodbye to them. We'll see them tomorrow or the next day. We're going to focus on the markets. Lori Calvasina with a really important note. She really popped the zeitgeist Friday evening, and she will join us as well. Francis Donald can I editorialize, Anna? Is it too early to editorialize?
I say yes. I have no power or control, but I'm saying yes.
Well, okay. Well, Anna, you always have power and control. And the answer is 75 beeps is a reach. That's what I hear within the literature. We'll talk to Francis Donald about that as well.
Well, maybe that's part of the problem, right? That 75 basis points is too much for this Fed. Tom Keene there, co-anchor of Bloomberg Surveillance, joining us to preview his program. Now, we may look back 5, 10, 20 years from now and say, why were we talking about the markets on a day like this? This could be the turning point, Anna, for our society. We may have to send a soldier back from the future in order to stop what's going on at Google.
I can see where this is going.
An engineer at Google has been dismissed, suspended, I believe, with pay, because he says Google's AI, its artificial intelligence, its chatbot has become sentient, self-aware. He says this chatbot that Google's developing may deserve human rights. Maybe we've reached peak woke here, but it's possible that this artificial intelligence has gone too far, according to this engineer, although Google says they've dismissed his claims and say, no, it's no big deal.
Yes, well, they say it's not sentient, don't they? I mean, I can't work out in 20 years, will we look back and say, yes, this was the worthy topic of really serious science tech books, or will we say this was sci-fi and that's where it stays? We will see, won't we? I think you were alluding to some Hollywood blockbusters which have dealt with this in the past. Let me tell you what is on my mind today, and that is also on your mind, I know, Matt, and that is how much hiking we're going to get from global central banks. If 75 is too much for the Fed this week, is it going to be possible we'll see 75 or more at later meetings from the Fed? I know, Matt, you have your thoughts on that, but we're also going to hear from the from the Bank of England this week. We got some GDP data earlier on this morning. We showed 2 months of back-to-back shrinking in those GDP numbers, negative GDP numbers month over month. And so how many hikes can we get, and of what size will we be able to fit in before we see real slowing in the UK economy? The Bank of England then meeting this week, as is the Bank of Japan. And we know that the weakness in the yen has been a real talking point. Their decisions, though, Matt, really different. They're still dealing with yield curve control there.
Yeah, I mean, there are central banks around the world that have different issues to contend with than we do, than you do, than Europe does, and Japan is certainly one of them.
That is it for the early edition. Surveillance is ahead. As you heard Tom say, they've ripped up the script. They are going to be talking markets, helping you through this turmoil. This is Bloomberg.